Well, we're past the inflation data in the US. We had PPI that came out yesterday. We had consumer prices that came out today. And we came off this massive jobs revision earlier this week. And I bring in Jim Welsh from Macro Tides. He's here to break it all down for you and talk a little bit about what's happening in the markets. Hey, Jim, how are you?
I'm good, Blake. How you doing?
I'm doing okay. I want to recognize that today is it's a dark day in American history. It is September 11th, as we all remember, September 11th, 2020 or 2001, excuse
One.
me, which is
Yeah.
24 years. It's hard to believe that was 24 years ago. It was the darkest day in American history, in my opinion. But yesterday wasn't too far behind as we have been coping with the assassination of Charlie Kirk. If you are not familiar with who he is, he is an activist, on the right. He was very popular, and it's a shame that these things happen. And I mean, me personally, I feel very much affected by it all. But just because for what he stood for, whether you agreed with Charlie Kirk or not, it's more that he stood for, debate and talk and have healthy discussions about different points of view, no matter where you land or where he lands. That's an important part of America. And between that and September 11th, it's been little dreary, but we promised we'd power through this. And Jim, I thought I'd pass it to you, just if you have anything that you'd like to add to that.
Well, 9/11 obviously was a huge event for anybody who was an adult, and obviously for the families directly impacted by it. So I think it is important to remember, just like we remember, January or December 7th, 1941, and so forth. In terms of Charlie Kirk, I really was not that aware of who he was. A little bit I saw of him, I was impressed that he was engaging young people, but he wasn't belligerent. He wasn't really belittling. It was like engagement. Well, give me your ideas, and I'm going to give you my ideas. And on balance, what I saw was a guy who was fairly respectful of those who had a different opinion. And it makes me think, like, we're in this era where diversity, equity, and inclusion is a big deal. A lot of people believe in that, and that's fine. Until somebody expresses a view, an opinion that doesn't agree with them. And, so it really isn't that accepting of diversity of viewpoints. It's, and it makes me think in terms of the colleges and what has transpired. I'm older, so I went to college a long time ago. But I was blessed that I went to a Jesuit high school and they taught us uh, how to think. The thing was question everything. And, I have found that to be a great attribute for me during life. I think today what happens in most colleges, kids aren't taught how to think and how to think critically. They're taught what to think. And the net result is, they're taught that diversity, equity, and inclusion is, paramount. And at the same time, there's borders on that only encompass those who agree with them. And that's just not healthy. So to me, what happened to Charlie Kirk is a reflection of a bigger issue and a problem. And I'm not sure how we change it or really move forward because, people are going to say, oh, it's just terrible, but, Trump is Hitler. I mean, seriously. Anyway, so let's go onward and upward.
Yeah, onward and upward, and we would power through this show, even on some of these dark days that we have to all go through because we're all going through it together. So, speaking of dark, Jim, I mean the jobs revision. Let's just shift gears to the
Yeah.
wait a second. So you're telling us that we lost over 900,000 more jobs in the last 12 months. And so this is supposed to be good. By the way, the stock market is at new all-time highs today, to
Yeah.
add to that. So what do you make of everything that we took in this week?
Well, we've talked about this topic, if you will, quite a bit the last 3, 4 weeks. We talked about the birth death model and how that was inflating the job numbers. In 2015, the birth death model, which for those who may or may not know what it is, the Bureau of Labor Statistics starting in 2000 tried to guesstimate how many new businesses were being formed and how many businesses were going out of business and how that was going to impact job growth. In 2015, the birth death model added 28% of all jobs. In 2024, it was 49%. So obviously, this thing has spun out of control. And I think what we're seeing with the quarterly revisions and then the big benchmark revisions, we're realizing that those numbers were grossly inflated. And we also talked about, hey, the estimate was somewhere between 550 and 950. It was 911. 911,000 jobs revised. So it's shocking. At the same time, Blake, those jobs never existed. We thought they did, but they never existed. So my point is, it's not like the economy has just had 900,000 jobs taken away. The number of jobs that are out there in the real world have been what has been powering the economy, irrespective of these revisions. So I think it's important to kind of, okay, take a deep breath here. Let's not get overreactive about, oh my God, the labor market's so much weaker. No, just because we're finding out now that it was weaker doesn't change the underpinnings of the economy. If we lose 900,000 jobs in the next 6, 9 months, that'll have a great deal of bearing on how the economy performs, down the road.
All
So I
right.
just want
Well,
to caution about overreacting against the revisions just because it's a gigantic number.
well,
So
so your first slide here, you want to talk about jobs. I mean, this is
yeah,
the August numbers. So tell us why you chose to bring this chart to our attention.
a couple reasons. Obviously, it's clearly you can see from this is that over the last 4 years, the number of jobs being created every month has declined. But it's important to understand the dynamics behind all this, Blake. In 2021, or pardon me, 2022 and 2021, as we were recovering from the pandemic, there was a lot of slack. A lot of people lost their jobs. And then as the economy reopened, they got hired back. And that's the case after every recession, even though we technically didn't go into a recession. What happens after every recession is you got a lot of people that are on the sidelines. The economy starts to recover. They come off the sidelines. So you get job growth that's 300,000, 400,000 on a fairly consistent basis. Well, as you get further along in an expansion, and the unemployment rate's closer to 4 than it is to 6 or 7, there's just fewer opportunities because the economy is already at full employment. So you're going to get a natural compression in job growth as you go over time as the economy expands and grows. The other point, and this is important, is that a month or 6 months ago to a year, 2 years ago, you look at how many jobs have to be created so that we absorb all the new entrants. And one of the numbers that has been pretty accepted is about 110,000, maybe a little bit more, 10 years ago, but 110,000. Well, given what's happening, we have, baby boomers retiring. We are removing some people from the labor market via deportations. And the economy is at a somewhat mature stage. So the point being is that how many jobs do we need to create to absorb new entrants into the labor market? And since 2007, birth rates have declined rapidly. So you have fewer naturally born people ready to enter the economy. So the bearing that this has on monetary policy is, are you going to get alarmed if it's down at 30,000 jobs? If you think, gee, we only need about 50 to 60,000 to absorb new workers. And I just think that's a component that will be in the conversation when the FOMC meets next week, is how many jobs do we need to create to absorb new workers and to prevent the unemployment rate going up. So again, there's a natural reaction function where if you think that, well, man, we were doing 160,000 jobs a year or two ago, and now we're only at less than 40 or 30. That's a real problem. No, you got to look at all these other dynamics.
Well, one thing that's not going to help and are these revisions. So let's
Yeah.
talk a little bit more about the revisions that we're seeing here.
Well, again, we kind of covered it. Birth death model created top line numbers that were fictitious based on the methodology. I do not believe that there was a conspiracy in the labor market or the labor department to change the numbers. I'll point out to those who think, like President Trump, oh yeah, man, they're all these numbers trying to make me look bad. It's all political. Well, last August, before the election, there was like a $800,000 job revision, negative revision, a little over 2 months before the election. You know, so again, I just think their models are faulty and they need to change. But again, it's not like we lost these jobs in the real world. We lost them in the statistical world. That's significantly different in my view than, like I said, we lose 900,000 jobs in the next year, we're going to be in a world of hurt.
Yeah. So when you say statistical world, I mean it's just the way that they're calculating. This is the whole reason why we have a new BLS, head.
Commissioner. And
Yeah.
hopefully they'll address things like the birth death model. They do this by mail. I mean, there's so many just common sense things that they can do, Blake, to improve the quality of the data and have it be more timely. Right now, only 60% of the questionnaires go out, come back by the time the BLS calculates any month's job number. So I think there's room to have hope that, they're going to make some meaningful improvements. And it's a tough thing to get your arms around. As I
It,
pointed out, 160 million people are working. 1/10 of 1% of that is 160,000 jobs. So, trying to get precision is really tough when you're dealing with such big numbers.
Absolutely. Well, one of the charts you brought here is layoffs. So this would be if we started seeing layoffs, that would be a big red flag for the jobs market, correct?
Absolutely. It's kind of like we're seeing all the things, JOLTS number of job openings is declining. Temporary workers have been getting let go. Hours worked have declined. Companies are uncertain what's going to happen with tariffs and how it's going to impact their businesses and sales and so forth. And what we've seen is, yeah, they're not hiring, or they're hiring less, but they're not laying anybody off yet. So you're 100% right. We've talked about this off and on, that this is the thing to watch. Now, the thing I'll point out is today, the Labor Department said, oh, the unemployment claims jumped to 263,000 from around 230. And oh my God, this is the signal. The problem is that this week's data encompassed Labor Day. And Labor Day was on the earliest day it could ever be, September 1. More often than not, it's September 4th and 5th.
Yeah.
So my point is the odds are that the seasonal adjustment factor got screwed up. The unadjusted data only went up 8,000. Plus, there was a storm down in Texas and they had a gain of 15,000. But what happened here is the bond market, I think, has looked at that and like, oh, okay, maybe that number isn't quite as weak as we initially knee-jerk thought. Equity's like, oh my, now the Fed's going to be cutting. Now they might even go 50 next week because, oh my God, the labor market is collapsing. So it's like the combined thing of the huge job revision, the
Sure.
weaker employment number for August, and now all of a sudden unemployment claims jump up. No one thinks about this stuff. It's just a knee-jerk reaction. I think my take is I think the Fed is still more likely to go 25 basis points next week, Blake, because of some of the things we're about to talk next.
Well, here's ISM. So what are we seeing here that has your attention?
Well, the last 2 months. So when the July number came out, ISM number, I pointed out, hey, look at this. The percent of companies reporting price increases and increase in prices paid was up to over 69%. It's still over 69%, and this is data through August. Well, there's a pretty good correlation historically, and you can see it. The dashed lines are the ISM service inflation numbers. The black line is the CPI. Well, if you advance 6 months in terms of or is that 3 months? I can't read it. You probably can read it.
Three
So my
months.
point is,
Yeah.
this is showing upward pressure on service prices. which are way more sticky than goods inflation is likely to turn out to be. So this is not what the Fed wanted to see. They can look through tariff inflation that is both focused on goods, but the service inflation, that's a different animal, and it's starting to kick up at exactly the wrong time.
All
I
right.
think.
So, and there are hopes that we're going to get 25 basis points, but and we're almost at a point, Jim, as if we don't get it, the market could be disappointed.
They're going to get 25 basis points, Blake. I mean, to me, we talked about this like 3, 4 weeks ago, I think. You've got the two dissenters that wanted to cut in July, Waller and Bowman, and then everybody else said, no, let's just wait and be patient. I think we're at a point where the people who've wanted to be patient are willing to say, you know what, cutting 25 basis points is a good compromise, and let's do that. But we're still concerned about things like service inflation, tariff inflation. We're cutting rates with the stock market at an all-time high. Gold is at an all-time high. Credit spreads are extremely narrow. I mean, like back to where they were in 2007. So is there really a high degree of monetary tightness when you look at what's happening in markets as opposed to a model that the Fed relies on in terms of what the neutral rate is, and nobody can define it just clearly and specifically. So again, I just think those who have been wanting to be patient are going to agree to a 25 basis point cut. I would be surprised if they would agree to a 50. They're going to be like, you know what? We're seeing inflation ticking up here. Let's cut 25 and let's wait for more data to come in, and we'll decide what to do next at the October meeting.
Speaking of inflation ticking up, here's your CPI.
Yeah. So the year over year 3.1, which was unchanged, the headline ticked up from 2.7 to 2.9. I always put a little more weight on the core because the Fed does. But so the point is, yeah, the annual was 3.1. But if you look at the last 3 months annualized, it's 3.65. So inflation pressures in the last few months have been intensifying. And in a perfect world, you want to see the light blue line below the black line. The light blue line is the 3-month annualized. The black line is the annualized. So what this is confirming is concerns about inflation pressures picking up. Well, that's what the 3-month annualized is confirming. That is happening. We just don't know, the magnitude and the duration. So again, this is fodder, I think, for those who want to go the patient route to agree to 25. I think they will be reluctant to go 50 and choose instead to wait for more data in the October meeting. The summary of economic projections, which we'll talk about next week, is when the Fed says, okay, for the next 12, 24 months, where do we think the Fed funds is going to be? Where do we think inflation, unemployment, and GDP is going to be? And so the number for the Fed funds rate will either confirm 3 cuts, which is what Wall Street is at now. They're like, we're getting 3 cuts. We're getting September, October, and December. Or is it going to be closer to 2 cuts? And I think to your point, could we get some data or some information out of the FOMC meeting and the SEP that disappoints people? I think if that's going to happen, it's going to come where it's only 25 and the SEP doesn't agree that we're going to get 3 cuts by the end of the year. That's where I think the disappointment will show up.
All right. Well, some disappointment might be building in this semiconductor chart. I mean, semiconductors are at their highs, but I think you are saying there's a little bit of divergence there.
I did. And, what I've emphasized in my letter the last 2 to 3 weeks was I think that the semiconductors hold the key to the short-term trend of the market. As we've talked, as I've shown, the advanced decline line has been making new all-time highs. So for the intermediate to longer term outlook, to me, the advanced decline line is saying, hey, you may have a correction in the short term, but the AD line suggests that after any correction, we're going to go higher. The semiconductors, to me, were signaling potentially that we would see a break below 280 and a drop towards the 262-ish level, which goes back to the highs off to the left. What we got was Broadcom news Look at what the stock did from 290 to 345. Oracle comes out and look at what the stock did
Yeah.
over the last, okay, I mean, it was up 25-30% or something. So that rejuvenated the whole thing about artificial intelligence because there were some concerns creeping in that maybe we've seen the best of it, and so forth. And those two stocks and what they had to say rejuvenated the stocks. But to your point, yes, it's made a new high. The RSI is not confirming it. And I think a case can be made here where this is a wave five, and any reversal that happens at this point in time, I think should be noted and respected. So we'll see what the next week or so brings. Do we see a reversal in the semiconductors? Because I think they have been one of, if not the leading group, certainly one of them. So if you want to have an idea of what the market's going to do near term, I would say focus on the semiconductors.
All right, very good. And how about the S&P here?
I thought we were going to have a pullback because of the strength in the semiconductors. You can see, hey, we got new life. So I was wrong about the semis. That has bled through, obviously, the S&P. The thing I'm pointing out is look at that red trend line above that comes in around 6,600. So my take here, Blake, is I think that will act as a ceiling in the near term. I think that's going to set us up for a retest or a test of the blue trend line underneath. RSI, compared to when the S&P, what was that in July? There's a negative divergence there. So that's just saying, hey, the market's still going up. It's just not going up at the same rate of pace or rate of change, and it's a warning. So all that together, the market has had this rebound this last week that I really didn't think or didn't expect, but it doesn't, I think, change the overall view that a pullback of 3 to 5% is coming. And after that pullback, I think we're going to new highs.
Okay, well, if you think we're going to new highs after that pullback, I'm interested to see what these other charts are showing us right now because TLT, well, I actually didn't bring TLT, you brought the yields. Yields are
Yeah.
dropping.
I thought you were going to keep talking. Give me a chance
Oh
to
no, oh
listen.
sorry.
No, no, that's all right, man. Well, again, the last few weeks, the expectation was that we were going to see the 10-year drop to 407, and that was a calculation. In Monday's weekly technical review, I said, you know what? I think it can get down to 4. That should be resistance. It got down to 399 and change. The RSI at the bottom is oversold, which is the opposite of, bond prices. It would be showing overbought.
Yeah.
If you look at those red arrows, when the RSI has gotten down to near 30, have consistently marked, if not a more intermediate term low in treasury yields, short-term lows, where you subsequently got increases of 20 to 30 basis points in the 10-year yield. So, my take here is calculations suggested we would see a decline in the 10-year. We're at that level. TLT, the range I had was 90.21 to 90.65. I think we got to 90.45. So TLT is right there. I thought the 30-year could dip under 370. I think it got to 364-ish maybe. So for me, Blake, the bond market is at an inflection point, a critical level where I expect that we're going to see yields reverse higher going forward. If
Wow.
the 10-year gets below
All right.
386, I'm wrong. In other
Okay.
words, that tells me that the idea that we're at a bottom in treasury yields that is going to be followed by the 10-year going above 5%, which could be 6 to 12 months from now. I'm wrong if the 10-year gets below 386.
All right. Well, where does that put gold? Because gold, it just looks so bullish, Jim.
Well, we had that red line on the chart 2 weeks ago or whenever it was. Yeah, the 28th. And it was above that. And like, hey, this suggests we're going to new all-time highs. And the expectation was that, okay, 36, 36.50, we got there. Monday's letter, I said, you know what? Time to take, if you bought it on that break above 34.03, which was to me the trigger for an upside move, Sell 25% on Tuesday effectively, and it traded like between 36.30 and 36.70 something. So I put up 36.50. I also said if it gets above 3,700, sell a little bit more. So, my take here is I think gold is at a point where you kind of want to sell into strength at this point and then wait to see what kind of a pullback. The most obvious pullback would be to 34.50 to 3,500. We went sideways. That should be a shelf of support for any pullback in gold.
Yeah, which will be right about here, guys.
Yeah.
Right there.
Yeah.
All right.
Yeah.
So the last chart you brought is the dollar, and the dollar is, I mean, it's heavy. We've got all sorts of data working against it. And we have a Fed that's going to cut rates. And if you look at, what the Fed is doing and versus other central banks like the ECB, who just met today and they're keeping rates unchanged, and it looks
Yeah.
like they want to keep them unchanged. I mean, doesn't it look like the dollar could go further?
Again, the last 2, 3 weeks as we've talked, I felt that the pattern had changed, that we were likely to see a drop below 96.37. I'm a little surprised, Blake, that there isn't more weakness in the dollar, given the news, expectations that the Fed's going to be cutting 3 times and so forth. I'm a little surprised that the dollar hasn't been weaker, but maybe on the reality of the Fed actually cutting, and maybe they will go 50, and maybe that will be what it'll take to get below 96.37. So
Yeah.
I think what the dollar's open to a drop to a lower low as long as it holds below 100.25. Again, my bigger, longer term view is the dollar has been the last few months forming a base and a bottom. And that once, if we get that drop below 96.37 or rally above 100.25, I think that's going to be a signal that the dollar is going to make a bigger move to the upside based on
Well,
positioning, sentiment, and everything else.
yeah. And I was gonna say, I said it on another show earlier that one of the traders in our community was saying that he's like the move that we've seen this year in the dollar has been massive. I mean, we have seen a massive depreciation of the dollar in just this year, and
Yeah.
it's hard to tack on further losses without there being some sort of intervention, or if there was a Mar-a-Lago Accord, okay, that would be called for. All right, well, maybe we'll see another
Yeah. Yeah. Yeah.
20% decline in the dollar afterwards. But when it's just data and central banks, this has been a pretty unprecedented move. So I could actually see, buy the rumor, sell the event kind of situation post FOMC this next week. And based on what you're saying, I think that is a higher risk than normal.
Yeah. And the other thing that factors into currencies is the outlook for economic growth in any given country. So, the Fed cuts rates and maybe they're going to cut again. And so you do get that drop to 96.37. But at some point in time, that's going to help the US economy. And maybe the US economy is going to be back in the driver's seat relative to Europe and other countries around the world. So there's always that aspect that it isn't just interest rate differentials that are the determining factor. I mean, interest rate differentials favored the dollar to go up this year, which at the beginning of January, a lot of people were pretty bullish the dollar. The price pattern to me suggested we were going to go to 95 sometime this year. It got to 96.37. So there's more things than the obvious that drive currencies. And, to me, the chart pattern, positioning, and sentiment are always important ingredients especially when sentiment and positioning reach extremes. So the guy you're quoting or referencing, it dropped 10, 11%, but it hasn't been going down for like almost 3 months now,
Yeah.
despite all the negativity that people have in their minds. And that to me is another tell that decline might have been the washout and that, things will get less bad for the dollar, which means
Well,
those short are going to have to cover.
we'll find out, Jim. It's
Yeah.
we'll be reconvening after the FOMC next week. So you guys, if you want Jim's most recent technical review, Jim, what's your email address that they can email you?
Jim Welsh Macro at Gmail, or go to macrotides.com.
Yeah, and make sure you guys jump down in the comments below. Jim reads them all. Give Jim a big thumbs up for being here every week consistently for like almost 4 years. I've been looking at how long we've been doing this. It's been a long time.
I know, it seems like forever.
It does. Thank you. I appreciate that. I think I've aged before your eyes. So Jim, thank you so much for being with us, and I'll look forward to catching up with you next week post FOMC.
You got it. Have a great week. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.